Tech jobs and stocks are up, layoffs are down, and the first AI software engineer is spooking tech workers. All while there's a 60% chance of a broad recession. As a tech professional, you might be wondering what this means for your career. And that's why I dove deep into the tech job market for you over the past 8 weeks. I analyzed data, spoke with senior leaders, and I worked with actual candidates in the job search trenches. What I discovered will help you understand the roller coaster we're on, where we're heading, and 5 lessons every tech professional like you should take away from the current market. We'll dive deep into hiring, layoff, and compensation data trends, and hopefully by the end of this video, you'll have some clear lessons to take action on. But first, I wanted to get you some historical context, so I spoke with the senior leaders who have worked in the industry for over 30 years to get a better understanding of the tech industry's past. As a senior director with over a decade of experience, I still only have a limited view of the history. And what they told me shouldn't surprise you. If you think this was bad, the biggest tech boom and bust was actually way back in 2000. And it took inflation-adjusted markets a staggering 18 years to really recover, especially with the 2008 recession hitting soon after. Now, for those of you actually hurting in today's market, I want to share a story that might give you some hope. This is Ethan Evans. He was laid off from his engineering job in 2003 with a new baby, a stay-at-home wife, and little savings early in his career. And he had to settle for a less-than-ideal job that required him to move. But things actually worked out for Ethan, way better than he could have imagined. He went on to become a VP of engineering at Amazon during their biggest growth years. Ethan's story hopefully gives you some perspective on the situation today. The road ahead might be bumpy, but with the right perspective, mindset, and strategies, you can come out on top. Now, that awful decade and a half made these tech veterans cry wolf quite a few times. If you look at the inflation-adjusted NASDAQ charts, you'll see pullbacks in 2015, 2018, and then of course 2020. And that spooked them into calling another tech job recession every few years. But there wasn't a job recession. The market came back and back and back again, roaring to new heights each time. In fact, 2021 was the biggest boom of all, with hiring and compensation at an all-time high. You might have experienced this yourself, multiple offers and top candidates getting 2 to 3 times the historical averages. It was a tech worker's dream come true. Then came the fall. Changing consumer behavior after lockdowns caused advertising and consumer tech to dip. The real trigger for the downfall was in March 2022 when the US Federal Reserve started raising interest rates to slow inflation. As a tech professional, it's crucial to understand how this impacts the industry. Tech stocks are valued on their future growth, and interest rates discount that growth. So when interest rates went up, valuations started dropping from all-time highs. As it became expensive to get money from investors or lenders, companies had to slow hiring, with many starting layoffs in early 2022. And then Elon bought Twitter, and he laid off over 80% of its staff. Showing that deep cuts are possible, Zuckerberg knocked over the first of the FANG layoff dominoes at Meta, leading even Google to lay off more people than they ever had in their history. Both Zuckerberg at Meta and Sundar at Google have said that slow hiring and occasional layoffs will continue as they believe they can grow much more efficiently. Zuckerberg outright said, higher interest rates lead to the economy running leaner. More geopolitical instability leads to more volatility, and increased regulation leads to slower growth and increased costs of innovation. Given this outlook, we'll need to operate more efficiently than our previous headcount reduction. And this is coming from the 2 companies who led the way in growing both tech hiring and compensation since the early 2000s. What is really happening, though, is that they're entering a time of uncertainty. There is a huge opportunity for them to ride another major growth wave with AI, but there's also a path for them to become just another slow growth giant, like in past cycles. As a tech worker, this means you need to be prepared for both scenarios. When these companies strike oil or feel threatened in a specific area, they will eventually need to hire furiously, even if that means laying off in other areas of the business that aren't the cash cows or the new area that they're trying to win in. Your job is to position yourself in the right areas and develop the skills that will be in high demand. So what specifically has changed in the job market over the past 2 years? In 2023, Carta, which is used by all the top startups as their equity platform, reported the first dip in startup employment in over 5 years. Layoffs peaked in January 2023, with TrueUp reporting over 108,000 tech workers let go that month, while open jobs in tech dropped by as much as 2/3, while new startup hires dropped 50% in 2023. But here's an interesting observation. The new hire rate was actually about the same in 2019 as in 2023. This suggests that while the market has slowed down from the crazy heights of 2021, we're not in uncharted territory. And if you look at the dips in total startup headcount, they're not nearly as dramatic as the massive growth seen in the past few years. So what does this actually mean for you? People still have jobs, but the dynamics have shifted. Employees became scared to leave their unsteady jobs after seeing 1 out of 4 of their colleagues hired in 2022 not even lasting a year, a 43% increase from the previous year. That's a scary stat, and it might make you think twice about jumping ship right now. Plus, entry-level employees were 25% more likely to cut, so if you're just starting out in your tech career, you need to be more cautious and make sure you're indispensable. Another trend you'll notice is that non-engineering startup roles were cut first. which makes sense as engineering roles are necessary to maintain and build products. This is especially true in the deep tech sectors. Fast forward to January 2024, and we saw another round of mass layoffs, about 60% lower though than January 2023, but it's still significant. But here's the thing, we knew this was coming. Some big tech executives I talked to in late 2023 said that they would be doing layoffs to appease their finance departments in exchange for being able to hire in the areas they wanted. And if you look at the data, it shows that. Open tech jobs actually accelerated, growing 17% since the new year until just about last week, down 55% from the 2022 peak, but nearing the 2019 levels. We're not sure where this will head, but it's much better today than it was a year ago. Meanwhile, big tech stocks are increasing and private valuations are ticking back up as investors are becoming more hopeful with IPOs like Reddit on the horizon, after only having a couple in the past year and a half. Big acquisitions like Adobe and Figma are also being shut down by regulators, and the percentage of startup acquisitions for large startups has been declining. But any of this recovery happening is K-shaped, with 2021 darlings like Firm, Zoom, and Match Group still not recovering, and the Nasdaq Small Tech Index has not bounced back as fast as the rest of Nasdaq, which is already above its 2021 all-time high. So what does all this mean for you as a tech professional? Let's unpack the 3 clear shifts that we're seeing that affect employees like you. Shift number 1, leaders are becoming individual contributors. Individual contributor hires in 2023 made up 30% more of the new hires than in 2019. Though surprisingly, 40% of new startup hires were still manager level or above. I personally have seen many of my manager and director friends taking on principal or staff level IC roles. This could be an opportunity for you to level up your technical skills and make a bigger impact without necessarily managing people. And although it's not a people management position, Meta has gone as far as eliminating the technical program manager role, hinting that it wants to get rid of anything that could be considered red tape. Zuck himself said, part of our work will involve removing jobs, and that will be in service of building a leaner, more technical company. So if you're in a TPM or project manager type role, it's time to start thinking about how you can pivot your skills to get closer to the technical, the product, or the business decisions. And number 2, most compensation took a dip after a run-up in 2022. Base salaries dipped only a couple of percent in aggregate, but entry-level roles were hit up to 25% last year. If you're just starting out, this might be a tough pill to swallow, but here's some good news. AI salaries continue to rise, and most salaries have started growing again in 2024. However, equity grants dropped as much as 37% and only just started to bounce back. And that's before the valuation declines across tech. That means if you're a startup employee, you got a smaller slice of an increasingly shrinking, or in most cases, disappearing pie as IPOs became a distant memory. If you look at levels.fyi data for an Amazon SDE Level 2 engineer, you see a downtrend in total compensation, but you also see since late last year, there's been a return of the top of band offers being given out. If the equity news wasn't bad enough, as startups hit record shutdown rates and falling valuations, fewer employees exercised their stock options, and many of those who did were left with worthless equity even though they paid for them. But as public stocks rebounded, startup valuations started ticking back up, and employees became more hopeful for IPOs after Reddit's debut. Employees are exercising again at similar levels to in 2019. 1 in 5 companies, though, gave employees more than the 90-day window to exercise after leaving. But it's honestly crazy that the window to pay for or lose your high-risk equity is only 3 months to begin with. Also, some startups with dropping valuations reprice their options grants to make them more aligned with the new value of the company. But I found in coaching candidates through salary negotiations that tons of startups were still overvaluing their equity, up to 5 times what investors would give them if they raised again. Shift number 3, AI and deep tech hiring didn't slow down as much as software-heavy industries like ed tech or gaming. And of course, if you were part of OpenAI or NVIDIA during all this, great for you. Your equity grants are worth many times more than they were before, and as the valuation skyrocketed, you're probably rich now. But for a lot of those tech workers who are laid off, they're actually starting up new AI startups. Many will go out of business, as with all sector booms, but more jobs giving workers valuable experience in the new area are now available. And you might be wondering, what about remote work? Well, Zuck and other leaders have cited data showing that remote workers had worse performance than in-office workers. But smaller companies and startups were still hiring more out-of-state workers until just the past few months. Things will start to stabilize, and hybrid work with just a few days in office is probably going to become the standard norm. Now, this may all seem like doom and gloom, but for some perspective, if you zoom out, we're actually still at near all-time highs in compensation and jobs in tech. But people don't think in absolutes. They only think about the relative loss. And part of that's understandable. You set up your life and your expectations around continued growth and stability. So here are 5 lessons all tech employees should learn during this job market. Number 1, play the long game. The tech industry has seen so many dramatic ups and downs that you shouldn't be surprised by another one. Look at Ethan's story. He faced a layoff during a tough time in the industry and in his life, but he bounced back stronger than ever, eventually becoming a VP at Amazon. The tech industry is resilient, and even with AI shaking things up, there will always be new opportunities for those who are adaptable and willing to learn. You need to make career decisions with a long-term perspective. So pick a company where you'll be happy even if the business or role doesn't turn out well in the next year or two. Make sure you're still getting skills and stories that will pay off long-term in your career, even if you have to move on. Lesson number 2, you don't need to run to AI, it will come to you, but you should be preparing. AI is going to make its way into most tech roles eventually, so instead of chasing after only AI-specific jobs, focus on developing the skills and mindset to work effectively with AI when it does arrive in your domain. A good rule of thumb is to either stay close to the deep tech or close to the money in your next role. And if you are in a technical role, either get more technical or learn to work and speak product and business. Lesson number 3, hustle hard in your job. The market is still really rough right now, so you're going to need to apply at high volumes with more prep and more personal outreach for referrals. And with open tech jobs still down over 50% from all-time highs, the competition is fierce. To stand out, you're going to need to be proactive. Apply to a larger number of companies, tailor your applications, and leverage your network for referrals. It's going to take more effort, but it will pay off. Lesson number 4, don't get blinded by startup equity. During the recent downturn, many startup employees saw their equity become worthless. In fact, only about 7% of Series C or later startups pay off much equity to employees. And many startups are still overvaluing their equity in offer grants. When evaluating equity offers, carefully assess how the company is valuing the grant and make sure that they take into account the possibility of lower valuation financing rounds or a longer runway until an exit like an IPO. Lesson number 5, the grass isn't always greener. I see tons of people in big tech angry about layoffs and jumping over to startups, and a lot of people in startups angry about their equity being worthless and wanting to go to the stability and liquid compensation to big tech. And it can be tempting, but remember, you're probably trading one problem set for another one. If you're going to startups, you can see by the data that your equity might not be worth much, and startups have laid off more people than the established companies like Google just up into recent times. Google hasn't had many layoffs in its few decades. Meanwhile, startups are shutting down, laying off people, and struggling with their business every single year, even during boom times, and still trying to figure out how to even treat employees well. On the flip side, jumping to big tech isn't a guarantee of more stability anymore. Nothing's going to be perfect, so make career moves based on a holistic assessment of the growth opportunities, the learning potential, and the culture fit, not just hype or prestige. And make sure it's going to work out for you, whether or not the company or your role is going to work out in 1 to 2 years, because you don't know what's going to happen. Make sure you're building achievements and success stories, and you're getting new skills in a new area. And some of you might be thinking, what about AI eliminating all these jobs? Well, AI is going to be used to increase productivity in tech workers, for sure. We've already seen Meta and Google building internal tools for coding and other functions, but the layoffs we've seen recently aren't due to AI, and the leaders of these tech companies have said so themselves. Instead, AI's impact will actually be on the longer-term hiring growth. There are 2 counteracting forces from AI on the tech job market's future. Number 1, AI will accelerate the economic and societal impact of tech once again, leading to more industry and job growth. But number 2, AI will also make companies more efficient, no longer needing as many workers for the same type of output. In my opinion, the net result is probably going to be a substantial growth in the tech industry. But many roles like customer support will be totally reinvented. Other organizational roles or lower level analytical QA and coding roles will likely be automated quite a bit. However, new roles will also be created to fill in the gaps between human and AI capabilities. So you have to stay nimble and remember that your career is measured in decades, not a single year. And now that you've learned these lessons, you probably want more tips on how to find a job in this economy. So check out my next video.